Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hello, everybody. I am very excited to be here today. Got a very interesting podcast for you. I want to go ahead and date the recording, though, because I think it's very important to do so. So today is Thursday, November 14th, and as of last night, I believe the Republicans reached 218 seats in the House. So we basically have a red sweep controlling Congress. Joyce, can we start over again? Yeah.
I'm on mute.
Yeah.
If you give me 3 seconds, then we can start again.
Okay.
Awesome. Have a good one.
Goodbye. Okay, so I'm super excited to be here today. We've got a really cool podcast for everybody. Today I'm going to be talking about the 2024 post-election red sweep. And today's date, I just want to make sure to put that in there so everyone has some context. So today is Thursday, November 14th. That's when I filmed this podcast. Not sure when it's actually going to come out for post-production purposes. But as of last night, on Wednesday the 13th, the House, the Republicans reached 218, so they have the majority. So they have the House, they have the Senate, they have the presidency. And so now what we have is a very interesting play on what's going to happen next with what taxes may look like in 2025 and 2026. So today's agenda, I'm going to talk about a little bit about tax history just to give everybody some context about how we got to today, November 14th, 2024. I'm going to go into the 2017 Tax Cuts and Jobs Act. I'm going to talk about, what happened back then. Go into a little bit about the Byrd Rule so everyone can understand what that means and how it applies to what's coming up with the tax legislation. I'm going to talk about some of the campaign promises that President-elect Trump made when he was on the road. Going to talk about the key players that are going to be dealing with the tax bill, so the ones in the Senate and the House, the timeline for potential implementation, and what's possible and what's not possible. And that's kind of going to be what we're going to talk about today on the podcast. So let's get right into it. The first thing that I want to go through, which it always is shocking to me when you look back at tax history, but if you look back at tax history, the top tax rate, and I always ask this question when I do presentations, who can anyone tell me what the top tax rate in the United States ever was? And it was 91% in 1944. So if you're talking about World War II, right in the thick of World War II, or at the very end of World War II, 94%. That was the top tax rate. The top tax rate was 94%, and then shortly after World War II, they lowered it to 91%. Then we get to the 70s, and it's the top tax rate. The late 60s, and most of the 70s, the top tax rate is 70%. And here's where we get into some tax history that I think everyone needs to understand. So in 1979, the top tax rate is 70% for married filing joint at a tax bracket threshold of $215,400. Okay, we get into then the election of Ronald Reagan to president, and he takes over in 1981. And in his every president pretty much gets a tax bill except for the first George Bush. And so President Reagan introduced the Economic Recovery Tax Act of 1981, otherwise known as ERTRA. And he lowers the tax rate from 70% to 50%. So the highest tax rate in 1981 is 50%. In 1986, there was the biggest tax change that we've seen since the 1950s. And so there's the Tax Reform Act of 1986, which brought in kind of the modern tax code that we have today. And that lowered the individual top tax rate from 50% to 28%. So it's a massive, massive, massive tax cut. We fast forward to George H.W. Bush, and I mentioned that he did not have a tax act that he introduced, mainly because he was such a big player in the 1986 Tax Act as vice president, he really didn't need to do a new one when he came into power in 1989. But the problem with him is that he did the classic, for those that remember, read my lips, no new taxes. And unfortunately, in 1991, for him, he had to pass a budget and he had to agree to raise the top tax rate from 28% to 31%. And a lot of people will say, if you look back on the history of presidents, that might have been the reason he didn't get a second term. We then move forward on to Bill Clinton, who was president from 1993 to 2001. And in 1993, the Omnibus Budget Reconciliation Act of 1993 raised the top tax rate from 31% to 39.6%. So that's where we get the modern, top tax rate of 39.6% comes from that tax bill from Bill Clinton. There was a Balanced Budget Act of 1997 that was also, quote unquote, a tax bill, but that was mainly on federal Medicare spending. We then move forward to George W. Bush, and W. Bush, in power from 2001 to 2009, basically introduces what's called EGTRA, or the Bush tax cuts, which was about $1.35 billion in tax cuts, and has a 10-year sunset, which is something that applies when you're doing what's called reconciliation, meaning that you have basically one party that's controlling the president, the House, and the Senate. And so there's what's called the Byrd Rule. And the Byrd Rule basically says is that when you pass something under reconciliation, there's three things you got to be careful with. You can't have anything extraneous to the budget. Okay, so it can't be anything existing outside of the budget. There can be no changes to Social Security. And I want to highlight that particular point because that'll play into what may be coming up next. And you cannot add to deficits for years beginning after the end of the bill's budget window. So you got to be very careful about how much it's actually going to cost, right? So with the Bush tax cuts, there was a 10-year sunset, set to sunset in 2011. Barack Obama, who comes in from 2009 through 2017, does the ARRA, the American Recovery Reinvestment Act of 2009. It's a stimulus bill. The economy wasn't doing too well back then, as everyone knows. For those that remember, you have the payroll credit, first-time home buyer tax credit, home energy credits, changes to itemized deductions. You then had the Affordable Care Act of 2010, which gives us our net investment income tax and additional Medicare taxes. And what's interesting here is that Barack Obama ran basically on a platform indicating, we don't like the Bush tax cuts as Democrats, but as part of the Affordable Care Act, he had to extend the Bush tax cuts for 2 years. So there had to be a bipartisan agreement to kind of push that forward to make everything work. And then what happens is that in 2012, a lot of those were made permanent. And we had a deal cut between then Vice President Joe Biden and Mitch McConnell to avoid the fiscal cliff. So that was the American Taxpayer Relief Act of 2012, also known as ATRA. And that's where we get, the top tax rate of 39.6 kind of hovers back to that. And the top U.S. capital gains tax rate of 20% comes out of that. So that was in 2012. The gift and estate tax exemption jumped to 5.12 million. So again, this is where we're seeing a lot of the modern day numbers. We then push forward to Donald Trump, his first presidency from 2017 to 2021. And we have the biggest change to the U.S. tax code since Ronald Reagan's 1986 Tax Act. It's the Tax Cuts and Jobs Act of 2017. It lowered the top tax rate from 39.6 to 37%. It doubled the gift and estate tax exemption. So it went from 5.12 million to about 10 million. You got double the standard deduction. There was a cap on state and local income tax deductions for itemized deductions. There was a cap on home mortgage loan interest deduction. So it's phased out between certain points, which I'll also want to make sure to kind of put a highlight on that one because we'll talk about that. There was the elimination of the personal exemption. And then there was the biggest change to the international income tax rules. We saw the introduction of the toll charge or the transition tax for a lot of offshore companies, followed by the new, I call it a global alternative minimum tax, otherwise known as GILTI. It's the GILTI tax that just tells you what Congress thinks about people that own foreign corporations. But the Tax Cuts and Jobs Act, one of the things I think that a lot of people should understand is that one was passed very quickly. It was introduced on November 2nd, 2017 in the House. and passed and signed into law basically on December 22nd, 2017. So 50 days from when it came into being to when it was signed into law. And that particular tax act expires on a lot of the provisions in it. Now, some of them were permanent, but a lot of them expire on December 31st, 2025. Some of them also expire on December 31st, 2026. And so leading into the election, a lot of tax pundits were basically calling this, the tax Armageddon, the tax Super Bowl, the TCJA sunset cliff, whatever, there's a wide variety of ways to look at this. I think a lot of folks thought that there may be a split in, House, Senate, presidency. There were some people that opined on a red sweep versus a blue sweep versus a divided government. But now we know that we have a red sweep, and, let's focus on exactly what was being proposed during the campaign. So, but before we get into that, let me just highlight one last point with the Tax Cuts and Jobs Act that everyone also has to understand. The projected cost of the Tax Cuts and Jobs Act was $1.5 trillion. The actual cost was between 1.9 million to 2.3 million. So potentially maybe a violation of the Byrd Rule there. And the cost to extend the whole thing in full is 4.6 trillion. So also keep that in mind as we kind of move through the podcast here. Okay, so let's talk about what the Republicans were, or President-elect Trump was promising on the campaign trail, what we may see come to fruition here in the next tax act, now that we have the red sweep, and we know that once all three control, you can push things through budget reconciliation. So the first thing that was promised would be the reduction in the U.S. C corporate tax rate. So President-elect Trump promised to lower that from 21% to 20%. There's also a promise of a 15% corporate tax rate for U.S. domestic manufacturers. So a special corporate tax rate for U.S. domestic manufacturers potentially in play there. There's talk about tariffs, and a lot of people have been talking about the proposal for tariffs, which people have thrown out 10%, 20% for a lot of countries. President Trump mentioned 60% for China. Those tariffs, though, are supposed to be used for a sovereign wealth fund. They're not to be used for a tax proposal. So when you're talking about things that can pay for a tax proposal, that's really not something that can be used there. We've never had a sovereign wealth fund in the United States, or at least not to my knowledge. So it'd be interesting if that were created and tariffs, increased tariffs were put into that. President-elect Trump promised that that fund would be used for enhanced childcare, whatever that means. So we don't really have a good idea of what that is. But for businesses, that was the proposals that were being made. For individuals, it gets a lot more interesting. The big thing here is to extend and make permanent a lot of the Tax Cuts and Jobs Act provisions. But there were commentary floating around about potentially lowering individual income tax rates. There is now commentary that potentially one way to make a revenue raiser is to take the tax brackets, and specifically the 24% tax bracket, and potentially raise that to 28%. So you would eliminate the 24% tax bracket. So it would go from 22% to 28% to 32%. So right now it goes 22, 24, 32. So that's a big mark of demarcation when you jump from 24 to 32. And now that jump would be more along the lines of 22 to 28. They, talk about making a higher standard deduction, so maybe increasing that a little bit more to keep up with inflation. I think a big fight will be the SALT cap. So there's a cap on the state and local income tax deductions for people that itemize at $10,000 for married filing joint, $5,000 for married filing separate. And this is going to be a big point of contention. And this is one of the areas where the Republican Party is really going to have to coalesce and come together and make agreements on how they want to treat this, because a lot of the folks that are on the East Coast and the West Coast probably really want to either raise the cap or eliminate it all altogether, because that's where it hurts the most. Whereas the folks in the middle maybe not so much, that they would care for that. But that would increase the cost of the tax bill if you were to increase the cap or if you were to do away with it. There's also some talk about extending the estate tax exemption, which currently is at $13.990 million. repeal the Inflation Reduction Act, environmental and clean energy credits, and repeal certain parts of the Inflation Reduction Act IRS funding, so there'd be less funding available for the Internal Revenue Service. And we'll talk a little bit more about that here in a minute. Other big items that were kind of promised on the campaign trail, especially at the end there was talk about eliminating income tax on tips and overtime. That's a very interesting proposal because you can eliminate the income tax, but under the Byrd rule, you can't eliminate the Social Security taxes. So on the tips and the overtime income, you would still have to know the total amount of income to calculate the Social Security taxes and potentially do withholding tax. If there is no withholding tax, I think it gets even a little stickier because now the individual has to self-report and calculate those taxes on their individual income tax return. The other sticky part about this is that while you may eliminate the federal income tax, states would have to conform to the new tax provisions to eliminate the state income tax. So you could have this weird thing where if you're in an income tax, a state that has a state income tax, there's no federal income tax, but there is the Social Security taxes at the federal level, and then there's state income tax that's being assessed. The same would be true for a promise to exempt federal income tax for police officers, firefighters, veterans, and active duty military. And I'll talk a little bit more about those folks here in a second, because that's a big ticket issue. But I just want to kind of finish off on this train of thought first. The next big thing that was talked about was auto loan interest deduction. And when we talk about automobile loan interest, there was a recent paper that came out from the Tax Policy Center, and they basically studied this when this proposal came out, and they looked at Q2 in 2024. So for quarter two, 2024, there was 39 billion in car loans with an average interest rate of 6.34% taken over 66 months. So that's roughly about $7.3 billion with lifetime interest payments of about 29 billion. So the question then becomes, if you are going to make auto loan interest deductible, is it what we call an above the line deduction, meaning it's being subtracted from gross income? Or is it an itemized deduction, meaning that it's subtracted from gross income before calculating your income tax? And since the Tax Cuts and Jobs Act doubled the standard deduction, a lot of individuals don't do itemized deductions. That's really for people that have a lot of mortgage interest and do a lot of charitable contributions. So a lot of high income individuals do itemized deductions, whereas the rest of the United States probably just takes the standard deduction. If you were to do it as an above the line deduction, though, the paper indicated that it'd be roughly about a $6 billion tax cut. So that's going to play into the final outcome for whatever comes next, whether you do it as an above the line deduction, which I think would be preferable for the voter base for the Republicans. That would encompass a lot more voters. Whereas if you did it as an itemized deduction, it would not be for a lot of people. It would be more for high income earners. There's also talk about including a limitation on automobile loan interest, so that there's only a certain amount that can be taken, whether it's an above the line or an itemized deduction. That may be another way to help eliminate the pay-fors there. Going back to the exemption of income tax for the folks that are being exempt from income, I just want to point out that there was a 2023 study about the total number of these folks. And it's roughly about 19 million US individuals that could be affected on this. About 1.3 million police officers, close to about 400,000 firefighters, 16 million veterans, and 1.3 million active duty military. So those are some big numbers. And if those folks don't have to pay federal income tax, that will add significantly to the cost of whatever tax legislation were to come next. So that's going to be, those things are going to be a very big issue when looking at potentially what comes next there. Other things that may come into play, there was talk about Americans abroad, and as far as, I think President-elect Trump talked about eliminating double tax for Americans abroad. I'm not sure what that really means. A lot of, the way the U.S. tax system is set up, and most tax systems are set up, There are a system of foreign tax credits that are available that do already eliminate double taxation. And I'm not sure that's what a lot of Americans abroad are worried about. There's a lot of other things that I think they're worried about related to compliance and all of the compliance they have to do, even though they live abroad, still filing the U.S. tax returns, still having to do international informational reporting with significant penalties. I think more so they would probably be looking for an easier way to comply with U.S. tax rules, as opposed to eliminating double taxation. The only area that I can see that in my mind that would have an issue of double taxation is the U.S. exit tax. And in some cases that does lead to double taxation, because there's a deemed tax if you give up the green card or to give up citizenship, and that phantom or deemed tax then is imposed at that point in time, potentially, if you're what's called a covered expatriate. Whereas when you actually sell the asset or realize the income at some point later on in time in the foreign country that you now live in, after you exit, there'd be another tax with potentially no way to mitigate or allow credits for the two. So that could be, the U.S. exit tax could be something that is ripe for change there. And then certainly, that is an area that has not been updated. That those rules came out in 2008, that the latest U.S. exit tax, and the only guidance that we really have on it is a notice from 2009. There's a test within the U.S. exit tax called the net worth test, that's at $2 million. And that's never been updated for inflation. So that would be something that I think a lot of people would be, would receive very well if they were to maybe update that to 6 million, 8 million, or 10 million. I think that would really clear out the pipeline for, U.S. exit tax issues, because that would eliminate a whole swath of individuals that don't have to worry about the U.S. exit tax. So that's where we're at as far as the proposals for the individuals, the businesses, kind of the issues that are floating around. Now let's talk for a second about the key players in the game. So in the Senate, we have John Thune was just elected the Senate Majority Leader, or just named the Senate Majority Leader. He sits on the Senate Finance Committee, which currently has 27 members, but there's going to be a lot of change there. Three retirements by Democrats. We have one Republican that resigned. We have two Republicans that lost their races for the Senate. So you've got 6 members that are going to be turned over in the next cycle. Plus you have John Thune, that is now the Majority Leader of the Senate. There is precedent for the Majority Leader of the Senate still sitting on the Senate Finance Committee. So potentially that he may continue on in that role, or maybe he might give it up to somebody else. You have Mike Crapo from Idaho, the Republican out of Idaho, that will be running point for a lot of the U.S. tax legislation proposals. He's kind of heading up the tax writing committees for the Senate. So it'll be real interesting kind of to see how he coordinates with John Thune. With John Thune, though, it's important to note that, he introduced the Death Tax Repeal Act of 2023 to basically eliminate the U.S. estate tax. It'll be interesting to see if that comes back into play for the next round. And that's one of the areas that I would kind of earmark to say, I'm very interested to see if that does come into play. Again, that's a cost right there. So if you eliminate that, there's a certain amount of tax revenue that is no longer received by the federal government. That's a cost of the bill that would have to be taken into account to be able to put something like that in. John Thune was also very critical of the funding that the IRS received from the Inflation Reduction Act. So that plays into kind of some of the campaign promises by President-elect Trump to reduce the funding of the IRS from the Inflation Reduction Act. And he also John Thune voted against the IIAJ in 2021. So that may play into some of the things that are going to be repealed to have quote unquote pay-fors for the next tax bill. In the House, you have Mike Johnson, who will probably be Speaker of the House, in my understanding. And then you have Jason Smith, the Republican from Missouri, that is the leader of the tax committee in the House. So Jason, we'll have to see kind of how Jason coordinates with Mike Crapo to put out the tax bill that's going to be forthcoming. But those are the folks that are going to be the key players that are going to be running point on whatever tax bill comes out next. And my understanding is that they have been working on what they want to go into the next tax bill already for a very long time in 2024, maybe even previous to that. And they are continuing to work on that right now as we speak, going into the next legislative session in 2025. So they should have a playbook ready to go very quickly. Which takes us into our timeline. Yes, this is very, very important. So going into the election, a lot of the tax pundits thought we're going to have a repeat of the Tax Cuts and Jobs Act. And just to remind you, the Tax Cuts and Jobs Act of 2017 was proposed in November of 2017, voted into law in December of 2017. So very late in the year of 2017. We believe, or a lot of people now believe, that the timeline could be greatly increased and could mirror what was done with the American Rescue Plan Act of 2021, which was under Joe Biden. That was introduced in January of 2021 and signed into law on March 11th, 2021. And so with budget reconciliation, you just need a simple majority, meaning they can fast track the bill. So is it possible that the tax bill comes out in January once session begins? Yes, it is. Is it possible that it's passed very quickly with not a lot of time to adapt or plan, and maybe goes into effect sometime in March? That is very, very possible as well. The Republicans will basically get two bites at the apple to try to get the tax bill passed. That's what they have the ability to do under budget reconciliation. And a lot of people believe that they will try to address taxes in one of the first two that are put out. So it'll be real interesting to see kind of the timeline of when this occurs, if it does happen very quickly, and when those rules would apply. And also, it's not beyond comprehension that potentially there could be some things in there that would try to be retroactive to Jan 1, 2025. I would be very hard pressed to see how they would do that, but it's not without saying that they couldn't try. As far as what is feasible, as far as what could be put in there, because the cost of extending TCJA in full is so high, it's $4.6 trillion, it's highly unlikely that you'll see a budget reconciliation bill that will forecast 8 to 10 years. It's what you would normally see under budget reconciliation. So in order to make some of this stuff more palatable, meaning that you could put more in there, like say repealing the estate tax, lowering the US corporate tax rate, exempting certain individuals' income, auto loan interest deductions, we're talking more like a 2 to 5 year timeline for the next tax bill. So we could literally be right back to where we are, or where we started, come 2026 or 2027, whatever the election cycle that comes in 2026, and then whatever happens in 2027. So that, this could just be a temporary tax law that comes into play for a couple of years, and then will have to be revisited, under the next election cycle. And speaking of the next election cycle, this is where I think it gets, again, a little sticky with the Republicans. They have 20 Republicans that are going to have to run for re-election in 2026, whereas there are only 13 Democrats. And so they have to be very careful about what they put out there and how that affects the American public, because, that next election cycle could be a little sticky. And historically speaking, the party that wins always loses seats, wins the presidency, always loses seats in the next election cycle. So I think they have to prepare for that and think about that going into that cycle. And then the tax bill will kind of have to mirror and mimic what can be done to make it work for that cycle. A couple other things I just want to note. There are, to go back to the Americans abroad for a second, there are 5.5 million Americans abroad, with the majority of Americans being in Mexico, Canada, United Kingdom, Germany, Australia, and South Korea. I think that this is an area that I'm hoping that President-elect Trump will really pay attention to, because I think a lot of those individuals, I think a large majority of those individuals either don't file or file incorrectly just because they don't really understand the cross-border tax issues, which a lot of those issues are centered directly on the podcast that I'm doing right now, the Essential Tax Podcast. We talk about a lot of the cross-border issues affecting those individuals that are living abroad. And I think it's very easy for those individuals to make very quick foot faults and then get stuck with not filing forms that carry significant penalties. And so I'm hopeful that one of the areas that they pay attention to very closely is, okay, how are we going to deal with these individuals that are living offshore? Is there a way that we can make their filing compliance easier? So one example I would have for that are individuals that say are small business owners but are offshore. generally fall into the U.S. controlled foreign corporate regime, which is very punitive and very sticky. And the form you have to file, the Form 5471, is the same form that Amazon and Google files. They're just filing it with more information and larger numbers. So it's the same complexity, though, that's applied to a small business owner. And perhaps there's a way to make that, maybe make a 5471 light form or easy form. I think that would be, maybe for small businesses that gross revenue is $10 million or less. I think that would be a very welcome change. Also, I think that there was an error in the 2017 Tax Cuts and Jobs Act that led to downward attribution. Fixing that error so folks don't need to file the Category 4 5471 for downward attribution, I think that would be very welcome by a lot of people. Other things that I think, should be thought about in the international context is when we talk about double taxation of U.S. folks living offshore. I guess one area that I didn't talk about earlier was the application of the net investment income tax, which is currently under dispute in court cases based on U.S. tax treaties. Most recently, we see this in the Christensen case, which is on appeal. But basically, for this particular issue, if there's the ability to get a foreign tax credit against the net investment income tax, I think that would actually help out and go a long way with resolving quote unquote double taxation for individuals living offshore. And then I think the last issue, and I did not talk about this when it comes to businesses, but there's Internal Revenue Code 199 Cap A, which is the qualified business income deduction. And that's used by a lot of sole proprietorships, and then offshore, those would be foreign disregarded entities or qualified business units. That the 199 Cap A deduction, my understanding of it, and I don't really have a great working knowledge of this for domestic companies because I really deal with this more with international folks. But for international folks, you don't get that deduction. So maybe allowing that deduction for international businesses would be super helpful. So for foreign partnerships, foreign disregarded entities, I think allowing that deduction to come into play there would be super helpful to really smoothing out the equality between people living in the U.S. versus people living outside of the U.S. that have this. But I think the 199 Cap A qualified business income deduction will also be a big point of contention, not only for individuals living offshore, but specifically for individuals in the or businesses in the United States, such as S corporations and partnerships. That income that's flowing through and the folks that qualify for that deduction are probably going to want that to continue moving forward. There's been a lot of talk about the fact that if that is done away with or that's eliminated, then perhaps maybe those folks would be better off in a C corporation, which would then put us back into rules prior to 1986. And there's also other issues to think about with businesses are the bonus depreciation issues that basically ends in 2026, and it's kind of petering out as time moves on. So there was talk about maybe putting that into a lame duck tax bill before the end of the calendar year, but probably not going to happen. So that's another little area that kind of is earmarked for potential issues. So to summarize, areas that I think that need to be looked at very closely or that people need to pay close attention to are going to be, for individuals, are going to be the tax rates. Will there be a change to the tax rates, perhaps somewhere in the middle? Perhaps the 24% tax bracket may be eliminated and the 28% tax bracket put in. If that's the case, you have a whole subset of individuals kind of right in the middle that will pay higher taxes. So, just to illustrate that, right now, if you're married filing joint in 2025 and you make between $201,000 and $383,000, you're in the 24% tax bracket. If that's eliminated and then replaced with the 28% tax bracket, you're going to pay about 4% more of income tax. Okay. The second big thing to look at is the standard deduction. Where will that end up falling at? Going into 2025, if you're married filing joint, that's about $30,000. Will that increase or will that stay the same? The third big thing is going to be the state and local income tax cap. Will that increase or will that stay the same? The fourth thing to look at is the home mortgage loan interest deduction and the limitation on that. That really needs to adjust with inflation, so that applies to more people. So what will that look like? I just talked about the 199 Cap A pass-through deduction. The estate tax exemption sitting at 13.99 million. Will that continue to move on? Will that be increased or will that be eliminated? I think those are the big picture issues to keep closely in mind for the extension of TCJA. Then as far as new things that may come in for individuals, we're keeping a close eye on individuals that may get exemption from income tax, keep a close eye on auto loan interest deductions, keep a close eye on potential first-time home buyer tax credits, and anything that may kind of stimulate the real estate economy. For businesses, it's really focusing on corporations and U.S. domestic corporations, potentially lowering the corporate tax bracket from 21%, or corporate tax rate from 21%, which is a flat rate, to 20%, and then a special domestic rate of 15%, maybe that comes into play. Again, a lot of this stuff costs a lot of money to fund. So if you're going to have a lot of these things come through that change the tax rules to benefit individuals and businesses, what's being done to pay for it? And what we talked about was potentially a shorter period of time that these things come into play, anywhere between 2 and 5 years, and then potentially eliminating certain parts of the Inflation Reduction Act, such as energy credits and reducing funding for the IRS to kind of pay for those things. So those are the areas that a lot of people need to pay attention to when we're kind of looking at whatever gets proposed next. I will kind of leave everyone with a couple things that I'm really sad to see probably will not be coming back. I was hoping for moving expenses to come back as an above the line deduction, and I was hoping that potentially someone would talk about putting in the 2% floor deductions on Schedule A as itemized deductions to write off, again, tax prep fees, attorney fees, things like that, wealth manager fees. I don't think that those are going to come back into play, so we're probably not going to see those. No one's really talked about those, haven't heard much about those. But as of right now, that's kind of where we stand for what may happen next with the next U.S. tax bill. We're going to have some folks from the tax writing committees potentially come on the podcast, or former tax writing committee folks come on the podcast as we get closer to the January timeline and speak to us more about how these things may work with Congress and what gets passed and what does not get passed. So I thank you for joining me today, and keep your ear to the ground because we have a lot more to come on this topic.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.